Well, Canadians are bracing for higher borrowing rates after the rate hike of the Bank of Canada, and rates are likely to track higher still, of course. Joining us for perspective is Ryan Bushell. He's president and portfolio manager at New Haven Asset Management. Ryan, you want to talk about what you see as the possibility of recessionary conditions in many parts of the developed world later this year. Before we get there, can you just give us your take on what our viewers and your clients need to understand about the Bank of Canada's decision yesterday and its posture, of course, that rates will be moving higher?
Yeah, thanks, Paul. So on the Bank of Canada specifically, I think the half-point rate hike is a signal, right? This is the first half-point rate hike we've had, and I don't even remember the last one. It speaks to the fact that central banks around the world have changed their stance rather abruptly, and I think they were job owning interest rates higher last year just by talking about we're going to raise rates, we're going to do this, and then I think with the conflict in Ukraine really stoking the inflation fire even further, now they're getting serious about actually taking action, and that was shown yesterday, and we'll see what the Fed does next month.
Okay, you have said in some notes that you've shared with us this morning that you do believe that recessionary conditions are a distinct possibility in many parts of the developed world. Are rising rates from central banks part of that story? Do central banks risk tipping their domestic economies into recession?
Yes, definitely. I think there's a lot of classic recessionary signals piling up right now, and people are a little bit complacent, I think, because the economy got through COVID so well, given all the stimulus that was in place. But look, that's all changed now. Stimulus is pretty much gone, fiscal stimulus in terms of, the average person getting benefit from that. Interest rates are going the other way, and they're going the other way quickly. There's so much debt in the system that even small interest rate increases, say 100 basis points, is likely to have a pretty dramatic effect on consumer cash flows. Food and energy inflation, we're only starting to see the effects of that. Remember, the inflation we're dealing with now is left over from the, running the economy on hot during COVID, so much stimulus in the system. We haven't really even seen the knock-on effects of the conflict in Ukraine. COVID's not over. We're having supply chain issues again coming out of China. What that's going to do to global manufacturing is an open question. We've got inverted yield curves, which are always traditionally a signal of recession upcoming. Now, again, 2 years versus 10 years is not inverted. It's gone back and forth. But suffice it to say that the yield curve is not showing a positive signal right now. And the last thing I would say that is kind of underestimated is that a lot of people are looking at, the job market is strong and the consumer spending is strong. Well, again, those are lagging indicators. When you look forward, consumer confidence is terrible, and the big thing too is that we had a lot of durable goods demand pulled forward during COVID. So we kind of papered over the recessionary impact that COVID would have had by buying a lot of stuff. Now that demand is satisfied and inventories are building. So again, I just see a lot of things piling up. It doesn't mean that central banks can't engineer something by reversing course, but if we continue down this road of rate hikes, I'm pretty confident that we should be prepared for some poorer economic times.
It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. Today, we are of course, joined by Ryan Bushell, president and portfolio manager at New Haven Asset Management. Ryan, you want to talk about sector rotation. The end of loose money from central banks has had a big impact on the way investors view stocks.
Yeah, thanks, Paul. And so if you look at the year-to-date performance of both the TSX and the S&P 500 and markets around the world, you've seen a massive change in flow of funds. You haven't necessarily seen funds yet leave the equity market, and that's what I think could be coming up in the case of pension fund rebalancing. As interest rates go higher, they're going to start to compete for capital in a way that they haven't for quite some time, at least the last 2 or 3 years. But if you look at the best performing sectors, it's interesting. Obviously the commodity sectors have benefited from, number one, being totally underinvested and people being not exposed to them coming into an inflationary spike, which is usually the case. That's how cycles work. But more interesting to me has been the performance of utilities and telecom stocks, which have performed quite well as people look for safety and income in a world where bond prices are getting crushed. So you're losing money both on an absolute basis and especially after inflation in the bond market right now. And I think people moving from riskier sectors like technology or, the meme stock craze, investments of lower quality, lower sustainability into things that are safer.
The performance of the telcos is interesting because there have been times in recent market history when rates have risen and we've seen the telco shares actually come off because their dividends look less appealing than higher yields on government bonds. Why have the telcos in particular outperformed this time around?
Yeah, it's interesting. And that's why you can't just use those rules of thumb in a vacuum. You have to look at what else is going on, right? It matters the level of interest rates we're seeing. 10-year bonds have gone from half a percentage point, 3/4 of a percentage point to 2.5. Well, telecom yields have been, steadily in the 4 to 5% range, even higher in some cases. So going up to 3% is not. Still doesn't compete for capital with the telecom yields. If they go even higher than that, that's when you will see that competition come back in. Historically, I always say this, when I started my career in the mid 2000s, BCE yielded 5%, Government of Canada 10-year bond yield 5%. So whichever one was more attractive, capital would flow either way. Now we're still in a there is no alternative world. Once bond prices stabilize though, and people start to look at those yields in a softening economy, that's where again I think flow of funds could start to come out of the equity market and into bonds and other fixed income products. And that's where again I feel that basically the whole market is overvalued to some extent, but I still think capital will flow from the riskier equities first, and that still to me is technology. Valuations have come down, but they haven't come down enough.
Would you be adding to positions in the telcos? As you've been speaking, I've just had a quick glance at the share prices of Rogers, TELUS, and BCE. BCE, of course, is the parent of this television station. All of them are either at or within shooting distance of all-time record highs. Would you be adding to positions in those stocks now?
No, I'm not. So I have quite a few new clients that have joined over the last, say, 6 months, and I've been very cautious on accumulating both telecom and bank shares, especially given the runs they've had year to date. I'm still holding my nose and buying some utilities and especially energy infrastructure. I still feel like the yields on those companies plus the growth opportunities within them remain strong enough. And it's not that I don't like telecom stocks. I'm just hopeful that we get a broader market correction where everything gets kind of dragged down a little bit, so we can add some more to those companies. But I think we're in a different paradigm now for the foreseeable future than where we were at even since 2008, 2009. It's going to be harder for central banks to grease the liquidity in the system. Interest rates on absolute basis are still so low. The last time we had sort of a market correction based on rates and slowing growth was 2018. But remember, we were coming down from a 3.25% Fed funds rate and Bank of Canada overnight rate. So we've still got some work to do to even get to that point where we can ease again. So, again, caution is warranted. I think our portfolios are set up well, but I don't really have a lot of good things to say about many in asset classes right now.
Okay, great stuff. As always, Ryan Bushell, thank you so much for joining us for a couple of segments on our show today.